In today's episode, I'm going to walk you through how to use MACD in your trading to help you. Number 1, avoid false breakouts. Number 2, focus on trading on the front side of the move and not overtrade the backside when the price action becomes congested. This is an indicator you can use whether you're trading stocks, forex, futures, cryptocurrency, doesn't matter, because MACD is a well-respected indicator. This is part of the universal language of the financial markets, that is technical analysis. So let's go ahead and jump onto the charts. I'm going to use a case study here. This is a stock that I traded just yesterday. I locked up about $5,000 of profit on it, and MACD was a big contributor to being able to lock up that profit and, most importantly, not overstay my welcome. Overstaying your welcome. How many of you struggle with not knowing when to walk away each day? I'm going to give you some tips during this episode to help you with that problem. I'll even give you some recommended readings so you can really dive in. Now, let's look at the 1-minute chart. As an active day trader, I'm using the 1-minute and the 5-minute time frames for finding my entries and exits. If you're trading a swing trading strategy or you're using different time frames, then you can use the MACD on the time frame that's relevant for you. It doesn't really matter because it's valid on all time frames. Now, MACD stands for, it's an acronym that stands for Moving Average Convergence Divergence. So what it's measuring is when moving averages are either diverging and moving apart, or when they're converging and moving together. In classic long-term investing, there are significant moving average crossovers that investors look at as indicating a very significant change in trend. So if the price, for instance, has been selling off for a long time and then starts to come back up, what you may see is, let's just say this is a long-term chart. This is the 200 moving average, which has been selling off like this. The price has been, sort of down here like this, but it's begun to turn around here. What you would notice would be the 200 moving averages here, and then let's just say your 100 moving average crosses over right here. So this is a moving average crossover. Moving average crossovers can be very significant for traders and investors because it signals a significant change in trend. And it's valid both on daily charts, but also on short-term time frames. So I think to help you better understand how MACD works and why it's so important, it's helpful to first give you a foundation in moving averages, because after all, MACD is taking moving averages as part of its calculation. So let's say, for instance, we have, it could be a stock, it could be anything, doesn't matter, it could be an indice. Let's just say the price is kind of slowly starting to move up and it starts to pull away here before dipping down a little bit and then pushing a little bit higher. So we would call this a traditional pullback pattern that generally I would enjoy trading something like this. But let's say it starts to move up here and then it kind of stalls out and the price kind of goes sideways through this area. Let's just say, for instance. So the way this would look on our chart is we would see our moving averages moving right behind the price. When the price is moving up, your moving average is always going to be a little bit below, because this is plotted based on the average price over the last X number of periods. Now, this is a moving average that I use, which is the 9-period moving average. So that means each one of these dots is the average price over the last 9 candles. Now, if the price is moving up, the average isn't way up here because you got to factor in the prices were lower back here. So it always trails slightly behind. Now, I personally use exponential moving averages in my trading. An exponential moving average is different from a simple moving average. You have an SMA or an EMA. SMA is a simple moving average. EMA is an exponential moving average. A simple moving average is simple because it just takes the average price over these last candles, whereas an exponential moving average takes the more recent price action and weights it more heavily. And what that means is that a 9 SMA versus a 9 EMA will look like this. This right here is going to be the EMA, and this is going to be the SMA. So the SMA will always be lower than the EMA because it takes longer for the averages to move up. When you're weighting more recent price action heavier, then the price moves faster. So what we look at generally when the price is moving up quickly, you've got your short-term moving averages that are going to move quickly, and then you've got longer moving averages like this, the 20 EMA, they're going to move a little bit slower. So the 20 EMA moves slower because it's taking the average price over the last 20 candles. So it's going further back. And then you'd have an indicator, a moving average that's even lower than that. For instance, the 200 EMA. So these popular indicators can form this ribbon here in a sense. And when they're all stacked above each other like this, then this is a time that we would be very bullish on a trade. However, what can happen naturally is if the price suddenly declines, you could have a moving average crossover. When you have a moving average crossover, it's indicating a change in trend. And the MACD is helping us visualize that in a way that's much more obvious than having it plotted on your chart with just the indicators alone. So if we look at our 1 minute chart again here, what you'll notice is that I have MACD plotted at the bottom. So this bottom section right here is the MACD. Now, I always get traders asking me, Ross, what are your MACD settings? So I make this extremely simple. My MACD settings are standard. They are default. I do not change them from the default setting that comes when you initially put MACD on your chart. Now, most platforms are going to put on the same settings, but I'll double click this and show you the inputs so you can just make 100% sure that you're using the same settings. So our fast length is 12, our slow length is 26, and our signal length is 9, and the source is close. This is the standard MACD setting. Essentially what this is it's using a fast length moving average as 12, which if we look here, instead of 9, it's using 12. Instead of 20, it's using 26. And then the signal length, the signal is 9. So it's a little different than the moving averages that I use here, but these work really well on my chart, and this is the standard setting for MACD. The reason that you want to use the standard settings for MACD is because you want to see the same signals that everyone else is seeing. If you start fiddling with this and changing it, it's going to significantly change the buy and sell signals. And then you're seeing something that you might be the only person in the world that is using these settings. So traffic signals, as an example, work because everyone respects them. Everyone knows what a green light, an orange light, and a red light means. But if you say, you know what, I'm going to be a little crazy. I'm going to use a magenta light. I'm going to use a blue light. All of a sudden, you're going to be off on another planet because no one else is using that. You're going to crash your car. And just like doing that in trading, you're going to start losing money because you're not going to get the obvious signals. So just as an example, I don't mind here. I'll just copy this. Let's see. So we'll just copy and we'll paste. So we have it on here twice. And I'll just show you, we'll just change this to like a 9 and a 20. And we'll change the signal length to like a 5, right? So all of a sudden it looks similar, but it is going to be different. Now you speed it up even more. You change it to a 3 or a 26, or let's see, make this like a 52. You're starting to really change the way it looks. So it may not seem super dramatic to you, but it is the difference between getting the signal at the right time and at the same time as everyone else, or being just off. So you want to make sure you're timing the market with other people. The reason here is that the market is moving because other traders have a belief that the price is either going to go up or go down. They're seeing signals. When they see a buy signal, they execute buy orders. So you kind of want to make sure you're seeing the same signal as other traders, because that's going to help you anticipate where we're going to see a move up or where we might see resistance or where we're going to see a move back down. This is what's going to help you avoid those false breakouts. Beginner traders who don't yet use the MACD are going to be more susceptible to falling into the traps of false breakouts. So this is, again, let's see, SGBX. This is a chart, 1 minute chart of a stock that I traded just yesterday. I actually made $5,000 on it. This was a pretty nice move. And it began right here at 9 a.m. with breaking news that came out. Okay, so we have breaking news that comes out top of the hour. And so initially, I see the stock on my scanners. So I'm using these stock scanners right here. So I'm getting an audio alert, bing, bing, boom, stocks on the scans. I pull it up on the 1 minute chart. And of course, I pull up the level 2. Now, when I first take a trade on something like this, I'm not really looking at the MACD in those first few minutes, because the thing is, this is a stock that has been going basically sideways and then suddenly has news that comes out. So I know that the moving averages are going to be spiking up. That's what they're always going to look like when you have breaking news. So if we make this really, really big here, what you're going to see is all of a sudden you've got your 9 moving average moving up, you've got your 20 moving up, and your 200 is down here, moving very slowly. So what's happening with these indicators? They are diverging, right? They're diverging. That's because the price is moving quickly. And so what's happening with the MACD? This blue line is moving way above the signal line. This is our signal line. And it'll continue to move up until the price begins to sort of stall out. So right here, the price started to stall out. The price rolled over a little bit. We came down to the support of the 9 moving average, but what began happening was our moving averages began to converge. They began to come back together. And that was especially noticeable right here when the price broke down. Because when the price broke down right there, that dragged the 9 moving average back down. That dragged the MACD back down. And right here, we have a MACD crossover. We have the cross where the fast line here, the actual moving average convergence divergence line, moves against the signal line coming back down. This, for me, is a critical indicator. When I see this crossover, I am no longer a buyer. Now, I'm going to hedge saying that by saying that as a beginner trader, you'll find more accuracy if you're only trading when the MACD is open. There are some times where I will take a trade when the MACD is against the position, and that's because I've got more experience. There are going to be more advanced setups, and they're going to have lower probability of success, but when they work, they can work well. So as a beginner, it's best to focus on setups that have the highest probability of success. So let's watch what happens right here. MACD is against the trade right here. So nothing in here you should be trading. No trade, no trade, no trade. And then right here, we can get back in. Now I'm going to do something kind of cool, and I'm going to actually drag this and drop it over this chart right like this. I'm going to go into settings. I'm going to turn off the histogram. So the histogram is turned off. We've got the signal line turned on right here. And we could make this, let's see, sometimes, this isn't the way to do it. So every now and then I will do something kind of like this, but I'm going to, let's see, I'm going to keep it like this for right now. This is what I was looking for. I'm going to make it a little bit bolder here. And then I'm going to do the same thing on this one. Okay. So now we basically just have it plotted right here, just as a reminder. Okay, so this, as soon as I see this, and as soon as I see it curling here, I know what's happening. I know this is getting ready to cross over. Sometimes putting it right in front of you makes it hard to miss, right? If it's down here, sometimes you might just stop kind of looking at it. So I'll do this occasionally. And I really encourage this for beginner traders. Okay, so we're going sideways here. And then what happens as we come into the open? We get the crossover. Do you see this crossover right here? Boom, we cross over. So we cross back over and we cross over with strength. And look at this move that we end up getting. So we end up getting a squeeze on this all the way up here. And we stay open. The MACD stays open. It stays open. And we push higher and higher, right? So we come up all the way to this level up here, about 620. We start to pull back. And then here we go. That's another crossover. So if you imagine focusing on trading this only in this area here and only in this area here, how do you think you would have done? Probably pretty well. Trading it in this area here, it was sideways. This is not going to pay you. We don't make money buying at 5 and selling at 5, or buying at 380 and selling at 380. We want to buy at 4 and sell at $5. And we would love to do that inside of 5 minutes, which is exactly what happened here. This went up over 200%. It's about 250% move. This was phenomenal. Now, my feeling is that if I focus on trading the front side of the move, breaking news, first spike up, that's fine. We pull back, MACD crosses over again, trading this next leg up, that's fine. I'm happy to trade the beginning, the front side of the move, and I want to avoid over trading when the MACD is against the position. So right here, MACD is against the position, we're not interested. What happens right here? Right here, the MACD begins to cross over. The price starts to pop back up. The price moves above the 9 and the 20 moving average, and then it comes back up to 6. Now, right here, when the price popped back up, the MACD was still negative. There was nothing to trade. Right here, when it popped up, MACD was still negative, right? So by this time, we had started to rally off the low. This was our low point, and we'd actually come back up this much. And because we had come back up that much, our moving averages were starting to get back to the crossover point. So now, what do you think is going to happen? Are we going to get a false breakout, or are we going to get a real breakout? Based on the position of the MACD, we should get a real breakout. And there we go, up to 7. Now we pull back again. We don't cross over, we go a little bit higher. This is an area where, oh, there we go, there's another crossover. Now this was, I'll admit, this was a bigger pullback here, and we almost crossed over, but we didn't quite, and then we came back up. So I would forgive you if you maybe didn't take this trade here, because at this point it was showing quite a lot of range. But then back you get to this spot here, and this is where, in this spot, I'd be done. I'd say, nope, I'm not going to trade that. And when it pops right back above, this is a high risk spot, and you've got a higher likelihood of seeing a false breakout. Now this did push a little bit higher, but you're always going to do best focusing on the front side of the move, the beginning of the move. So that's going to be when the news first comes out, and then during the first pullbacks. Now let's look at BENF. So this basically out of nowhere squeezes up. And it's kind of like an example where we have breaking news, except that this didn't actually have news. It just started to squeeze up, and all of a sudden it punches higher to 260. The MACD is crossed over, is positive, and is in favor of the trade. So now we squeeze up to 290, up to 3. Let's see, I'll put this on auto. We squeeze up to 340, up to 350. We pull back, MACD is still open. First pullback, do we buy this dip? The answer is yes, because the MACD is open. The MACD is in favor of the trade, so those are dips that we're buying. Okay, we keep moving forward here. We push even higher. Right now, this is just very strong. Now we dip down here, and this is a significant dip, and you can see that the MACD is starting to come in against the trade. Okay, now we push a little bit higher, but right there is the crossover. So imagine if you stopped trading it right there and you didn't trade it again for the rest of the day, or at least until you got another crossover. You would be in good position for doing that. That would have been the right move, right? Now it starts to come back up, but it doesn't cross over, right? Now right down here, you get a little crossover. At this point, this is later in the day, probably wouldn't have traded this. I like to focus on trading the front side of the move, the beginning of the move, the first pullback, the second pullback. Now, I don't leave this plotted on here like that. I'm just putting that on there for your benefit, just so you can't miss it, just so it's very obvious. This is how I have MACD plotted on my chart. So I've got it plotted right down here, and you can see the way it's moving up like this. There are times where I've changed the coloring on this and kind of tried to make it pop a little bit more, and that's fine. You could do that, but the settings always stay the same. You don't want to change the settings. You start fiddling with the settings, and now you're going to get different signals from what everyone else is getting. Now, the people that are using MACD will do better as a result if they use it consistently. This is one of the biggest challenges with indicators. If you end up putting 30 indicators on your chart and you don't check them all before you take a trade, then they're not helpful. Checking them periodically or checking them intermittently does not work. They work when you follow them on every single trade you take. That's what you have to do. So if you're going to use MACD, you got to use it on every trade. And what I would encourage you to do is use it for a period of a few weeks and just see, does this help me? Is it helping me avoid false breakouts? Is it helping me remember when to walk away? And if it is, you should keep it on your chart. Now, I've been trading for a long time. And when I first started trading, I used MACD, I used RSI, I used stochastics, I used a couple different indicators, but I never really figured out the right way to use them. And so eventually I dropped them off my chart. And for a long time, my charts were very simple because I didn't have MACD on. It was just a very pure chart, just the candlesticks and the volume bars and these moving averages. But during the bear market of 2022, when the market pulled back nearly 30%, I found that MACD was really helping me avoid false breakouts because we were seeing a lot of false breakouts. We had a real headwind in the market. It was difficult, and I needed to focus on improving my accuracy. So when I popped MACD on, I really found it helped me. And I've now kept it on since that time, and I really believe that it helps me in my trading avoid these false breakouts. Now, if you want to know a little bit more about technical analysis, I'll put a link in the description. I'll pin it to the top of the comments that you can download my technical analysis PDF. It's the ultimate technical analysis guide. So it's got chart patterns, indicator stuff, all the things that you need to know if you're interested in trading the strategy that I trade. So check that out, pinned in the top of the comments, and you can download it. Now, when it comes to learning when to walk away, this right here is a book called Quit. The Power of Knowing When to Walk Away by Annie Duke. This is something that helped me quite a bit. This helped me understand that the best traders will trade longer and dig deeper when the market's hot, and will walk away even if they don't hit their daily goal when the market is cold. So in a sense, daily goals are almost irrelevant for really good traders because they know that, yeah, when the market's hot, I'm going to probably far exceed my daily goal. But when the market's cold, it's going to be hard to get there. And it wouldn't make sense to try to push really hard to get that daily goal when the market's cold. It's just not worth it. It's not worth putting in the fight. So I really encourage you to try to detach yourself from an amount of money you need to make every day. I think it can be very dangerous. And instead, try to shift your focus to optimizing your efficiency as a trader. When you're making money at a high rate per hour, those are the days you should trade more hours. On the days when it's not happening, those are the days it's not worth sticking it out. So learn to walk away sooner. And instead of trying to have as many consecutive green days in a row as you can, which is a stupid thing to worry about, but we often get very obsessed with it, focus on how many consecutive days in a row you can maintain discipline. Because if you can maintain discipline for 30, 40, 50 days in a row without falling victim to emotional hijack, without spiraling, you are going to do very well. This is about focusing on the process. The profits are a byproduct. If you enjoyed this episode, I hope you hit the thumbs up. I hope you subscribe to the channel. Make sure you download my ultimate technical analysis guide, and I'll see you for the next episode on trading strategy right here.